Hello, and welcome to the Finance Library. This video is designed for physician leaders who are responsible for managing hospitals or healthcare facilities. When you review this video, please do so in conjunction with the various tools and resources at our website, www.finance-library.com. Together, I think they will help you go beyond just the concepts and get you to a point where you are in a position to implement some of these ideas in your work. At least that's my hope. If you find this video helpful, please do check out the library of content available on our website as well as on our YouTube channel, the handle for which is @finance-library. There is quite a bit of content there, both in terms of videos as well as tools, as well as reference guides. So with that, let's get started. In healthcare, and for that matter, in most sectors, there is a tendency to treat financial performance as a single number, say a return on equity measure or a return on asset measure. These assets tend to be opaque, especially because you, as a physician leader, may not always know what goes into those numbers to get you the final result. And more importantly, if you want to look at what exactly you can do and what are some of the factors that are driving these results, how various operational decisions are driving your health system forward, or some of it is dragging it down, you need a diagnostic lens that goes beyond just looking at one measure. And that lens is one of such lenses is the DuPont analysis. So let's start with the question, what is the DuPont analysis? At its core, what the DuPont analysis framework tries to do is to take a well-known measure such as return on equity, okay? Which is a very commonly used finance metric, and then try to decompose that into three separate levers. So rather than look at return on equity alone, which is measured as income over the equity employed, you break it down into three parts: profit margin, asset efficiency, and capital structure. And what that allows you to do is to look for now operational levers that you can pull to affect these three elements, which in turn positively affects the ROE. Now, I know that you're not familiar with some of these measures, so we will go into these metrics more carefully. But before I go there, I'm just going to talk a little more about how this entire framework came about. This framework, which is called the DuPont Analysis, was developed in the 1920s by the DuPont Corporation. And their goal in developing this tool was to help investors and managers understand what was driving a company's performance, whether it was being driven by high profit margins, or was it driven by very efficient utilization of assets, even when the margins may not have been high, or did it all come about because the company was highly leveraged? It used a whole lot of debt, and that debt was what was driving the results. Now, over time, this tool became very popular, and so much so that you will find it pretty much in every single finance textbook you have today. And this is a full 100 years later, right? I use it in the classroom a lot as well. Now, when you hear this, you may be going, hey, that is all well and good, but why are we talking about a method that was developed over 100 years ago, and that too for an industrial company, in the context of the healthcare space? That is an excellent question, and a very rational one too. So it turns out we are not the only ones talking about this question, and it turned out that certain researchers were curious about it too. So what they were curious about whether the DuPont equation is indeed helpful in the healthcare space, the way it was helpful in the industrial space. So what they did do was to study about 3,200 or so hospitals to see if they could use the DuPont equation to examine the performance of these hospitals. What the study found, quite remarkably, was that by decomposing the ROE into margin, asset turnover, and capital structure, the three components that we talked about a few minutes ago, they were able to explain the differences in performance across a whole range of hospitals, whether it was investor-owned hospitals, not-for-profits, teaching hospitals, critical access facilities, or system-affiliated hospitals. In other words, they could analyze different hospitals and use the three DuPont equation attributes to explain the variation in performance across various hospitals. The study is quite remarkable and robust in its findings, and it's often described as a landmark study. But even before I came across the study, I was a big fan of this simple yet powerful tool because I've seen it be very effective across many, many sectors. And I have used it extensively in my consulting work. So I figured that just sharing with you a little bit about this tool and how it works might be helpful for you as well in your day-to-day operational decision making. Again, so the way we apply the DuPont equation is you start with the basic question: how much income are you generating relative to the equity capital, the amount of money that the owners have put into the operation, where the income is the numerator and the amount of equity is the denominator. Okay. Then what we do is we decompose this equation by multiplying and dividing by revenue. So we are multiplying by revenue here. We're dividing by revenue here. We're multiplying by total assets here and dividing by total assets here. And then because you're multiplying and dividing by the same numbers, this revenue and revenue technically cancel each other out. Total assets and total assets cancel each other out. So essentially, we are still working only with net income and equity. But what this kind of inclusion of revenue and total assets in the equation does is it allows us to rearrange the equation and to come up with three metrics which have their own interpretation. So for instance, net income divided by revenue is a measure of profits or a profit margin. Revenue over total assets says, given a level of total assets, how much revenue are you generating using those assets? It's a measure of efficiency. And similarly, you have the third component, which allows you to see how much of your total assets was financed with equity. And so now you can see as a healthcare leader which component is driving or dragging your financial performance. And then you can focus on that, of course, in conjunction with everything else to align your or to make operational changes such that you get to the right strategic outcomes that the board and leadership is interested in. Okay. Now, one additional thing I would say is that not in all cases is the equation return on equity split into these three. If you are a 100% equity finance business or you're a nonprofit where the ownership component doesn't work for you, you can kind of get rid of this last piece and reorganize this equation to say instead of return on equity, it becomes return on equity and assets. And so you have an equation where you get rid of the last component and you just have the first and second components. That is, you maintain profit margin and asset efficiency, and you get rid of the capital structure or the equity multiplier in the equation. Again, just to be clear, the three components are net income over revenue, which is the profit margin, it tells you for every given dollar, how much of that revenue do we get to keep after paying for labor, supplies, and clinical care. So what's the numerator is what's left after everybody else's, all the stakeholders are compensated. This is the revenue. So this tells you what's left for the equity holders relative to the revenue that is being made. So the profit margin for equity holders is what you pick up in the first component. The second component tells you, how efficiently you're managing your assets, how efficiently the beds, the operating room, and the equipment are actually producing revenue. And then finally, the last component, the equity multiplier, tells you how the organization is financed. The more debt you use, lower the equity and higher the ratio. And the less debt you use, higher the equity and lower the ratio. Okay. Now that brings us to an important point about DuPont equations, right? Yes, on the one hand, we have identified the three components, but if you notice, all of these components are financial measures, right? Now, finance is not how you manage an organization. You manage your organization through operations, which in turn have certain financial outcomes. So if you're going to manage these financial measures and you're going to try and maximize them so that your ROE is maximized, you need to figure out what operational metrics or operational levers you can pull to be able to maximize these measures. So I've identified a few in this chart. So for instance, revenue quality, cost structure, and value-based performance are all performance metrics of the operational metrics that drive net margin, capacity utilization, patient throughput, or working capital are factors that drive asset turnover. And similarly, the leverage metrics and how capital planning is exercised may drive equity multipliers. Okay, so let's look into some of these operational KPIs a little more carefully. Okay. So first, let's start with the first of the factors that are the components of the DuPont equation, namely net profit margin. And within that, we are going to focus on one aspect or category of operational KPIs that drive net profit margin. And we refer to that as quality, revenue quality. Okay? So one category of revenue category quality KPIs is the case mix index. So now when I say the index, that I'm not talking about the a particular index that I have in mind. All I'm trying to think of here is some sort of a score that captures the patient complexity and the equity of the kinds of cases you treat. And what that means is that a higher complexity score would reflect a higher severity of illness. And why that matters is because the more complex and the more severe the illness, you are justified in requesting a higher reimbursement level, which in turn affects revenue. So bottom line here is that the case mix, the more complex, the greater the revenue potential. The next set of KPIs relate to the concept of payer mix. What the payer mix tries to measure is the percentage of your commercial versus public or state-sponsored patients. Because generally speaking, commercial compensation is higher, so your commercial percentage turns out to be a key margin lever. Because the higher the percentage of commercial patients, the higher the payment for per unit of service, and that skews the revenue higher, right? So everything else remaining the same, presumably you would prefer a more higher percentage of commercial patients. But the reality is that you may have a mission, or you may be located in in a geography where you may not have the luxury of being able to pick and choose what kind of patients you treat. But no matter what, it is an important metric to track because you know that higher the proportion of state-sponsored or publicly sponsored patients for every unit of service, the less revenue you are likely to generate. Finally, we look at charge capture in the revenue cycle. So the rate at which, what this refers to is the effectiveness with which your services translate to revenue. Okay? So if your claims are all accepted without challenge, that would suggest that your ability to claim revenue is high. If, on the other hand, your denial rates are high, you are now left with having provided the service and not being able to collect revenue for that service. Similarly, how much time it. So even when you can collect, if it takes a significant amount of time between the time you bill and the point at which you collect the revenue, that and all of the other factors that we just discussed, essentially what it does is create a wedge between the provision of care and when and how much revenue you actually collect once the billing the revenue cycle is complete. So these are different metric KPIs. Now, I'm not saying that these are the only KPIs, but broadly, these represent three categories of KPIs. What you're trying to get at is what do these factors drive, do they provide tailwinds or headwinds to your revenue? And depending on what you see with these KPIs, you can now take action to improve the quality and the timing of your payments. With that, let's shift to the expense side of the margin equation and specifically cost management. Again, cost management within the net profit margin component of the DuPont equation. Now, within costs, typically for a hospital, labor cost is a significant component. So labor cost percentage is potentially one of your most important operational indicators. But the downside is it's incredibly complex to manage. You're all constantly trading off clinical staff requirements, trying to figure out how to get agency staff as needed, but not use too much of agency staff or outsourced staff. You have to deal with union agreements, and then always you're trying to balance this tension between having enough people to ensure patient safety, but also not having too many employees so that your financial efficiency is impaired. Another cost management KPI is the length of stay. This is a remarkably powerful margin metric, I should say, because reducing a length of stay down to your target benchmark is one of the direct ways you can expand your profit margin without having to do things that reduce your revenue or compromise care volumes. And so the length of stay is often considered a extremely important operational metric for leaders to track and to manage. Lastly, we have value-based payments. As you know, reimbursement rates are typically adjusted up or down based on clinical outcome, or patient experience, and safety and efficiency. So this means that a significant proportion of your hospital's revenue is directly contingent on the quality of clinical performance. So, and we will talk about this later too, but this is again another set of KPIs to track because it has implications, perhaps not directly sometimes, but indirectly very often on the cost of on managing costs to increase profitability and then ROE. So now moving on to the second driver, namely the asset turnover. We're going to start by looking at capacity utilization. On the left, we track inpatient occupancy, which is the percentage of beds occupied at any given time. This is typically the most widely used measure of inpatient capacity or efficiency. But when you use this measure, we have to remember that there are some operational challenges in managing this metric. For instance, if we were to, all of us would love for this metric to be 100%, right? Every bed at every point is completely used or occupied, right? But the reality is that when, and in the case of most hospitals, when occupancy starts exceeding about 90%, you start to run out of slack in the system. You're operating on everything on a just-in-time basis, and that tends to create burnout and among staff and just overall stress in the system. But on the other hand, if you let occupancy slide and it slides to, say, around 60% or in that vicinity or lower, what is then going to happen is that you have this massive infrastructure and overhead and fixed costs that you're running, but you're making poor use of that investment. So now you have a significant dilution in the way in which you use all the capital investments that have been made. So for most hospitals, the sweet spot tends to be in the 75 to 85% range of accuracy. And of course, you would like within that higher occupancy rates than lower. A similar pattern can be observed in the operation room block utilization. The operating room is both the highest revenue area in the hospital segment of the hospital, and it is also the highest cost, especially fixed cost segment of the entire hospital. And because of that, every single underutilized hour in an operation room is an incredible waste of fixed capital assets. So in order to do that, of course, hospitals try to maximize the block utilization of the OR in an attempt to optimize asset turnover. Again, they too run into challenges of too high, you have too much pressure in the system and not enough slack, and too low, you have dilution of or the underutilization of critical assets. So they too try typically to track something like 75 to 85% in operation room utilization. Now, again, continuing with the theme of asset turnover, if we turn to some of the other components, other operational KPIs that we can track to improve asset turnover, the two that come to mind are throughput and working capital. They represent kind of the operational financial drivers that maximize asset turnover. So what is throughput? Throughput is the rate at which essentially patients move through the system, from admissions to treatment and to discharge. High throughput, for instance, in the form of faster emergency room turnarounds, reduced bed wait times, highly optimized operating room scheduling, all of that allows a hospital to treat a higher volume of patients without needing to add more physical facilities or major equipment. So when you can throughput a larger number of patients through the system without having to invest more, it has a very direct impact on asset turnover because it boosts net revenue while keeping the total assets unchanged. So you have the benefit of a improvement without really having to, this is all operational. You're not changing the kind of investments that are needed to increase the throughput. Through operational changes, you are increasing the throughput, thereby increasing the asset turnover. What the working capital KPIs bring into focus is another aspect of hospital management. It measures how effectively the hospital converts its short-term resources into liquid cash and revenue. So efficiently maximizing, idle pharmaceutical inventory, or accelerating the reimbursement, insurance reimbursements, and the collection of accounts receivable. All of these frees up cash, and the more cash that is freed up, the less the need for outside financing. And so by effectively managing these kinds of investment, short-term investment, and keeping it to a minimum, you are now able to run the hospital with a higher degree of financial efficiency, meaning that you need lesser capital to run the operation and you need less of outside financing. Examples of commonly tracked throughput KPIs are metrics such as the ratio of observed length of stay relative to target. So higher the observed length of stay relative to your target length of stay, the less efficient you are. And you may want to look at this by case type, of course, because the length of stay varies by the type of cases you're dealing with. And similarly, other throughput KPIs you might use are emergency room metrics like door to provider times and wait times and so on. From a working capital perspective, we tend to monitor two primary metrics. First is accounts receivable, which measures the time from service delivery to the time of actual cash collection. So the greater the number of days between the two, higher or larger the accounts receivable, the days it takes to recover your the cost of your service, right? So every day that your potential revenue sits trapped in an accounts receivable account, that represents cash that is completely then unavailable for basic operations. So your time to collection, the longer the time to collection, meaning that you are essentially lending money to a third party, which means that you don't have access to the money for basic operations, for servicing debt, or for even near-term investments. The second measure under working capital that hospitals or organizations typically track is the days cash on hand. What this tries to measure is how many days the hospital could continue to operate using only its current cash and short-term investments, as if all revenue streams suddenly ceased. You might be wondering why. That seems like an extremely stark kind of circumstance. But the reality is that even when you're not dealing with extreme situations, cash on hand is very helpful for operational stability, because hospitals rely on cash reserves to cover immediate and surprising expenses. For instance, if there's a sudden spike in medical supplies that's needed, to meet payroll and even unexpected operational disruptions. It also ensures the ability to pay vendors and staff on time, even when there are temporary revenue flow issues or the collection times increase for reasons outside your control, or even during emergencies or low patient volume periods. So it kind of provides a financial cushion, and it serves as a rainy day fund to weather periods of distress, financial distress, or low margins, or tight circumstances, right? And thereby keeping the organization afloat, even when other circumstances are not favorable. Now let's look at the third and the final component of the DuPont equation, the equity multiplier. The capital structure component of DuPont equation is particularly important to the physician leader. Because while operational managers focus on margins and throughput, executive leadership must or are responsible for ensuring that your capital structure can safely support the operational engine that you are running, and it can support future growth without introducing any insolvency risk or financial distress. So what the equity multiplier does is to evaluate your capital mix. Like I said before, it tries to find the right balance between debt or equity in terms of how the assets are financed. The way in which we track the equity versus debt position is through a few metrics, and one commonly tracked metric is the debt service coverage ratio. It tries to essentially looking at the question, do we have enough operating cash flow so that we can comfortably service our debt obligations? So as you can see on the screen, the formula looks at the numerator of income and certain other non-cash expenses and such as depreciation and interest, and divides it by principal and interest. What you're trying to do here is that, do we have enough cash from operations to comfortably cover the principal and interest expenses that are due in that given period? Okay. Now, aside from looking at the adequacy of profits and cash flow to support the debt payments, it is useful to track the scale of debt relative to the scale of operations. So often what is done is we look at debt relative to both patient volume or the revenue of the organization, because these metrics can provide helpful indicators of the debt level of indebtedness relative to the scale of operations. And the scale of operations, like I said, may be in terms of the number of patients and or revenue. And finally, we look at the capital investment ratio. It is not directly tied to the capital structure the way the other two metrics are, but what the reinvestment ratio looks to do is figuring out if the organization is investing or reinvesting enough in the organization in relation to the aging depreciating assets or equipment. Okay. What that means is that at a healthy level, a good level of capital reinvestment would mean that for at least every dollar of depreciation, there is at least $1 or higher of replacement. Right. So for every dollar loss of value in the underlying asset, you are continuing to reinvest so that you maintain your equipment and physical plant at a level that doesn't cause a loss of required assets, right? So a healthy level would be 1 or above, but if you were to see capital reinvestment ratios that fall below 1, let's say 0.8, that is to say, for every dollar loss of value in the asset, we are replacing only 80 cents worth of value. And if you say, let's say you sustain that for a few years, what that will signal is that you now you're building up a significant backlog of capital investment needed. And if you're building up such a backlog, it is important for leadership to recognize that, yes, you're avoiding that reinvestment today, but essentially what you're doing is building up a large and potentially costly remediation program, which will be needed in a few years. So although it is not directly tied to the capital structure, it alerts leadership when large capital needs are being deferred, and also alerts them to the potential future need for capital. Okay. So now we have talked about each of the three components of the DuPont equation. We looked at each of them, and looked at the operational performance indicators that you can manage to get to the higher levels of the three metrics: net profit margin, asset turnover, and better leverage ratios, so that you can maximize the ROE of your organization. But there are a few things that you have to remember, because if you manage each of those metrics in silos, right, each of those components of the DuPont equation in silos, there is a risk that those kinds of choices can create unintended consequences. Because remember that the DuPont equation is multiplicative, right? A weakness in any single driver compounds across others as well. But additionally, it is important to remember that these metrics or factors are interrelated. So to start off, let's take the case of what I call a triangle between length of stay, margin, and turnover. So if you were to lower your length of stay, that's fantastic because it cuts variable costs. And reducing the variable cost in turn improves your margin. So managing the length of stay tightly does good things for your profit margin. It also frees up additional beds faster, which means now you can handle greater throughput, which means you can handle more cases with the same capacity, which means your asset turnover is also high. So just by managing length of stay, you have had two benefits, namely profit margin as well as asset turnover, two of the three components of the DuPont equation. But there's a risk here. If you slash length of stay considerably and you manage patient transitions poorly, what will then likely happen is that your readmission rate will spike, and especially if you are heavily reliant on state-sponsored programs, then the higher readmission rate will often trigger penalties, which then tend to compress your margins right back down. Okay, so again, lowering your length of stay improves margins and asset turnover, but if you handle that badly, it can then cause penalties, which then offset some of the gains you had on the profit margin side. A similar kind of circumstance exists when you deal with payer mix and volume. So for instance, if you take on more state-sponsored patient volume, that can be very great, especially on paper, because what it does is you have greater throughput of patients and it improves your asset turnover and bed occupancy. But then, because the reimbursement rates for state-sponsored patients is lower, what you're doing is you're giving up your net profit margin. So on the one hand, your asset turnover improved, but your net margin came down. Now, that might look very worrying, but again, what the DuPont equation allows you to do is to do sensitivity analysis. So for instance, if you were to say, I'll increase my proportion of state-sponsored patient by 5 percentage points, you can run an analysis to see what that does to your asset turnover and bed occupancy, and whether that improvement is high enough to offset the lower reimbursement rates and the lower margins that result. So you can now quantify this trade-off based on evidence than on anecdotes. And then finally, also remember what I call the capital investment paradox. Let's say you add a new building to your organization, your facility, you expand beds or purchase significant amounts of imaging equipment. All of these will increase your assets, and as a result, immediately reduce your asset turnover, especially in the near term, even when you think the investment is needed and perfectly sound. Why? Because your numerator has not changed, right? Because what's happening is that your revenue stays the same, a new building comes on, new equipment comes online. It takes time for those assets to be utilized on a steady basis and at a level that makes sense, commensurate with the cost of the investment. So the ramp up takes time. So what happens is the numerator stays the same, the denominator has gone up. You suddenly see a significant dip in asset turnover, which then causes the ROE to come down. So this can, create concern among various other leaders in the organization. So it is important to set expectations appropriately and for leaders to anticipate this temporary dip as a result of these large investments. So give me 1 second. So yeah, so that brings us to a important point, which is that as much as I love the DuPont equation, and often I'm a cheerleader for it, I want to highlight that it is not an all-encompassing tool. It is very powerful, but is unable to track certain key drivers of operational performance. So let's consider some of them. So for instance, if you consider patient safety and clinical quality, right? If the hospital ends up with healthcare associated infections, medication errors, and other kinds of adverse events, all of this have significant financial consequences for the facility. However, none of them show up in the DuPont equation, right? Because they impact various components of the P&L, but are not necessarily directly picked up in the DuPont equation. So which means that if you're going to track some of these metrics, you might need a clinical quality dashboard separately to be able to monitor these additional factors, which are clearly not going to be observable within the DuPont analysis framework. Similarly, the workforce issues such as staff engagement or burnout also have high dollar as well as reputational costs. Again, this is also not obvious in a DuPont analysis. Similarly, physician coding accuracy, referral patterns, market shares are all, critical determinants of hospital financial performance. Yet it appears nowhere in the DuPont equation. And further, we must remember that the DuPont equation is backward looking. So if you have declining market share or changing employee relations, that may not be visible in the financial statements at all, on the operational metrics that we are tracking at all. So they may be completely missed. So again, just a reminder that while the DuPont equation is very powerful, it is not an all-encompassing tool. And then finally, I would also remind you that just the idea of using financial metrics such as an ROE or a DuPont analysis can become very problematic if you are a nonprofit system where you carry community benefit and charity care commitments that by design reduce financial performance. So in those cases, we have to remind ourselves that maximizing ROE is not and should not be the sole objective of a mission-driven organization. Okay? We are coming close to the end of this discussion, but what I've done here on this slide, I've put together a one-page reference connecting the DuPont equation to various financial metrics. Hopefully, it's not complete. It is, these kinds of metrics that we have talked about in the earlier parts of this discussion. Hopefully, it serves as a cheat sheet that you can reference later, and it can help you it's something you can use when you're structuring board reports or service line reviews, and then or even operational improvement initiatives. So the key takeaways, again, to wrap up the discussion, is that the DuPont equation is not just a formula. Because it is directly connected to operational levers. It can serve as a diagnostic tool, allowing you to get insights into what kind of operational changes you can make to improve the three drivers of the DuPont analysis, namely profit margin, asset turnover, and the capital structure. It is helpful to remember that associated with every metric, there is a operational KPI, and there are of course, these operational KPIs are owned by different parts of the organization, but it's important to have a dashboard of these operational KPIs, because those in turn drive the financial metrics. Also remember that the drivers interact, so you have to model them together. It is risky to look at one metric in isolation, one operational KPI in isolation, or for that matter, one driver of the DuPont analysis in isolation. Have to understand that they are both multiplicative and also dependent on each other. And then finally, we noted that the DuPont equation is very helpful, powerful, and a very powerful tool, but it has its limitations, and we have to keep that in mind while using this tool in day-to-day decision making. So with that, we complete this video and the discussion of the use of the DuPont equation in hospital management. If you found this operational breakdown valuable, do head over to the financelibrary.com website for the various tools that are available there that might help you with some of the analysis that's discussed in this video, and also a hospital KPI framework guide. And also, don't forget to subscribe to the YouTube channel. And then finally, a note of caution: do remember to apply professional judgment when you are using your own health systems numbers and some of the techniques that you have discussed, and especially benchmarks. These are benchmarks that I use as a reference and for illustration. They may not be the right benchmarks for you, so do apply professional judgment as you do analysis within your organization's context. So look forward to seeing you on the next video, and thank you for your time.